Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Tuesday, November 8th, 2022. It's 3:26 p.m. Eastern Time. I'm starting the video. So this one will get out to you after the close today because I'm going to go over total 30 stocks is what I plan to do. Yeah, I'll rifle through those charts pretty quick, but what I want to do in this video, other than a brief update on the equity markets here, I'll start out with, since I have the podium here, just do an update on those wedges that I posted on NQ and ES. And then I want to show you really the rest of the market, what's been strong. I've been hyper focused on and trading mostly the Nasdaq 100 and higher beta, high tech names, the former market leaders. That's what took the market down. Now let's focus on what's kind of buoyed the market. We've certainly had a bear market. Every index has been down over 20%, but some like the Dow just barely, and then the S&P 500 really a mild bear market by almost all accounts. 20, I don't know, I'll check it, 25%, something like that, give or take. But I want to show you what's held up, what's been strong. We have some stocks at or near all-time highs, and so I'm going to do that for two parts. Number one, to share some trade ideas with you on those and some of the other stocks I go through, and number two, to paint the bigger picture, where we're at in the cycle, where I think we may be in the bigger picture of things. Where we're going. Not today, tomorrow. This is today, tomorrow, next week kind of stuff. And then when I go to the weekly and monthly charts, that's next month to next year, and so forth. All right, so these are the wedges. Let me tighten it up here real quick. And like I said, it's a volatile market, and if you want to minimize the chance of whipsaws, you wait for 60-minute candles. But you do have. Let me tell you a couple things here. So I mentioned I've used that term for many years. It's just a pattern I've noticed, early on in trading, because I do a lot of wedges, bullish falling and bearish rising wedges. And then I noticed when you have a nice clean wedge with divergence, it's unusual, but once in a while I'll see that, and I call it a wedge overthrow or overshoot, where right about the point where the wedge should break down, when you're getting near the apex of the wedge, 70-80% apex where the two lines would intersect, that would be somewhere over here. That's usually where you break down, and then once in a while you'll get the opposite will happen. You have an upside break, and it's usually like this, very impulsive, and then the signature move at that point is an equally impulsive move back down and down straight throughout the wedge. You don't stop, pass go, collect 200, go straight to jail, and usually cut down through the downside of the wedge. And so that's what happened. Now so we did have a 60-minute closing candle below it. Wasn't very far below, and it was right above that was the first support level I had on NQ or ES, I'm sorry, 38.18. So you call it the BOD support. So you really want to see a 60-minute close below there, and you didn't get it yet, and now this 60-minute candle is still working. If they dump it in the close today, and we're below the wedge, then that sell signal will stick. And if they park it well above here or higher, then it's all just double whipsaws. This is a whipsaw above and then a whipsaw below. So we'll see where that goes. The other one is NQ, of course. That's ES right there, the S&P 500. And on NQ, let me tighten it up for you here. You had almost the same thing. There was your wedge overshoot. Very impulsive right here. I wanted to circle that, followed by a move down back into and below the wedge, only to park that 60-minute candle well above the first support, BOD, benefit of the doubt, 10,974-ish right there. We did get a 60-minute close below the wedge, so that is a sell signal. But now this next candle we're working on right now is above it. So again, we have 30 minutes to go exactly. As I say, it's 3:30 right now. And so we're either going to fade into the close and then confirm the sell signals, or we'll park here, go higher, and then there is no sell signal. So that's all short-term stuff. Welcome to a market that's full of whipsaws, and just, it's fine. You take these shorts, and if it tells you to get back out, cover it. If you go back down, you can always get back in. And if you shorted, I would hold on and see where this candle finishes. That's my preference. And give it a 60 minutes, see where we close. All right, now to longer term stuff. That's all short term, near term. We're going to go look at the a few sectors here in the S&P 500. So this video is somewhat a follow up to the other one. Now, in the video I did earlier today, I was focused on the Fibonacci retracement, showing you again, just trying to lay out, because I know where I used to be many years back, decades ago. You know, if I was new to investing or trading, I've always had my, my whole background is financial markets. You know, after graduating with a business degree and working as a financial advisor, I've always been, immersed in the financial markets. But I can understand how some might confuse a rally like we've had for the last few days, or even off the lows, is nothing but bullish. It feels bullish. That's called recency bias, and it could prove to be bullish. I've made the case here, divergent low on the daily and weekly charts. For decades now, those have been, at least since the 2007 to 2009 bear market, divergent lows on the weekly chart have always been the catalyst to new highs and beyond in the market, in the great bull market. So maybe that proves to be the case. We won't know until hindsight. But I also showed you that the last true bear market, that 0709, we had a similar divergent low and a similar point in time in the bear market, and it proved to be nothing more than the catalyst for a bear market rally followed by the next leg down. So I'm still going off that theory for all the reasons I told you in the earlier video, and what I'm going to show you here is we're going to focus on what's been strong in the market. I've spent so much time showing you what's weak, shorting these big fangs, following the cues, and now let's look at what's held up. Just going over the daily charts, even if I turn off the online, you can know tech. We all know what happened. Tech led the way down. Tech, we're in a rising interest rate environment that tends to hurt growth stocks more so. They feel the most pain, and so obviously tech has let us down. And it's also simple mathematics. Let's not forget that the top components of the Nasdaq 100, of the S&P 500, are your techs and your fangs, even if they're not considered techs. Some of these, for example, you have Apple and Microsoft in XLK, but then you have in XLC, you have Alphabet and Meta, and that's considered in the communication sector. And in Amazon, it's consumer discretionary, XLY. That's how they lump them in there. Even Tesla is considered that, but some will consider those tech stocks. Amazon initially was considered a tech stock, right? Started out selling books online. So call it what you want to call it. Again, semantics, but they're all, they tend to move together. So we know what happens. The tech got hit the hardest. We look at healthcare, and this is just a daily chart. Here's your high right here. Healthcare is held up relatively well, as it should, because healthcare is a defensive sector. Defensive sectors are those that tend to either flourish or go down less in a bear market or a recession, because they're business models. When you get sick, you don't stop going to the doctor or the hospital, whether the stock market's down or we're in a recession. You're still going to go to the hospital if you get sick, or the doctor. And so healthcare tends to hold up for that reason. Financials obviously been moving down pretty well, a little counter-trend rally. Communications sector, again, Alphabet and Meta is really the main culprits here. XLY, consumer discretionary, again, Amazon's and Tesla are the two top components there. Industrial's gone down, but rallying somewhat, but still well off the highs. Again, I'm just kind of showing you a gist of where we're at. XLP, that's consumer staples. Energy, we know where energy was. I showed you the analog, or the comparison to 2007, 8, 9, that tech was one of the first to go, and then energy was one of the last, or was the last sector to go. And that's almost a perfect repeat right now. And again, part of that, among other things, beside it being a crowded trade, that's where the profitability was. There was still a lot of the speculation had moved over into energy stocks. In the previous bear market bubble, in 2000 it was dot-coms, and then in 2007 at that market top it was financials and energy that was really overvalued, and then financials started getting it first when the housing market turned, and then eventually XLE cratered. So the takeaway from this, guys, is we're looking. I'm going to show you the ones that are strongest right now. To me, look like they're increasingly looking like the best shorting ops if you share that common thesis that I'm working off of, for the reasons I explained in today's earlier video, that we're still in a bear market with more downside to come. Because what's going to happen if that's the case, you'll see the current market leaders. Remember, forever and a day, the FANGs were considered the market leaders: Apple, Amazon, Meta, which is formerly Facebook, Alphabet, and the likes. Those were your market leaders. They are no longer. They took the market down. They're the market anchors, if you want to call it that, right now. So the theme of this is going to be, you'll see some of these leaders join the rank and file. Rank and file, the way that's defined, rank and file is defined as members of a group or organization who are not leaders. All right, so right now, Apple and Amazon and Meta, they are the rank and file, even though they used to be the leaders. So the leaders now are XLE and some others. I'm going to go through here, Energy. And I'm going to make the case that they're probably going to join the rank and file, because that's what happens in a bear market. Eventually, bear markets, it's like little assassins going out there, and they're finding their targets. They first kill the leaders. They shoot the leaders. And they've already done that. They've already killed the FANGs, taken them down, and they're going to go out and they're going to continue to hunt until they get all their trophies, and they're looking. They'll be coming after these leaders here soon. I'll show you the technicals. We'll make a case for it. Some of them might be actionable now, some aren't. And another strategy is a paired trade. Tech, I've showed you those are divergent lows everywhere. You can make a pretty strong case that tech might not be at a bottom, but it might be at a tradable bottom. And so you could be long tech and the FANGs and those former market leaders now, and short those that haven't rolled over yet. So then you have a long short portfolio. You're shorting the strongest stocks that have yet to fall, because there's probably less upside there, and you go long the techs, and so that way you're kind of somewhat of an indirect offset. So here's XLE again, right at the previous bear market, bull market high, threatening to make new highs here. Utilities have already started to come down. Same thing, remember, they didn't roll over until late, just like the last bear market in 2007-8. Why? Because they're considered defensive stocks. These are the king of the defensive sector. Steady Eddie dividend-paying utility stocks. Number one, they pay a dividends. People are going to collect that. Helps to offset losses in a bear market when you're collecting some type of income stream, and utilities have consistent dividends. And number two, for the same reason, healthcare, it's a defensive sector. We go into recession, you're going to cut back on the Nike Air Jordans or whatever the thing is for your kids or whatever. Pick your poison, your extravagant thing. You might cut out the NFL package on your satellite TV, right? Things are getting tough. You lose your job. You do what you got to do. But what you're not going to do is stop paying your electric bill. That's one of the last things you're going to do. So these are usually they're considered defensive issues. But like everything in every bear market, they eventually come after the leaders, those that are strong. And you can see it happening already with utilities, and I think energy will be next. And I'll get to that in a second. Real estate's already been moving down, and then basic materials. So most sectors are well off the highs, and by almost all metrics, we're still in a bear market. There's no evidence the bear market's over. There's some developments that say we could get a better, bigger, more upside on a bear market rally. But again, as of now, as I've covered in the video earlier today, most trend indicators are still saying solidly in a bear market. So we're going to go off that theory. If you disagree with it, maybe there's some takeaways for you in this video. Maybe you can see some trade ideas, or maybe you're long and bullish some of these strong stocks, and I'll give you levels that would be a short seller would look to short on a break down. So let's start with energy real quick, because I mentioned that the other day, I think it's time. We've had several other times. I've posted shorts on this in the past, but when you look at XLE, the energy sector ETF, this is big oil right here. Chevron, think Chevron and ExxonMobil. And I pointed out the other day, they broke down right here. They had a sell signal. The sector as a whole. And there's your big red candle. And all it's done since then is back test. So it's still an objective short entry because you're below the primary uptrend line. So you've seen there's been these uptrend lines like this one here. And you break them and you go down and you hit target. Then you have another leg up, and then they're clean. See, what do they have in common? They're clean trend lines. Look how many reactions on that trend line. And then look at the breakdown candle. It's almost all green candles, and any red candle was above there until there. There's your breakdown candle. And a lot like, me, I like to trade things that are pretty much unidirectional. They're either going up or down. Natural gas is one of them. That darn thing is either rocketing up or rocketing down. If you get those trends, you can make a lot of money trading it. Even if you don't have to bat 1,000, nobody ever is going to bat 1,000. But look at this: you drop, and then you go in an uptrend, and then you drop. You have a sell signal. You go down, then you start a new uptrend. You break down. There's a breakdown candle, and you drop. And now here we are. We broke down. Sometimes you break down, you never look back, like right here, and sometimes you break down, you back test. So still objective. PPO is about to roll over. The crude shorts playing out so far. This is a 60-minute chart of crude futures. Yesterday posted shorting natural gas after closing out long on the gap up. But there's that 60-minute bearish rising wedge on CL crude futures. We were hitting here. We're dancing on this support. I have a good support level right there, or had one at 90.31. Boom, it was taken out. We went down to the next target, and so forth and so on. I still think we're going down at least to this trend line here. That's going to put pressure on the energy stocks, if so. Natural gas, what happened? We gapped up. This is just a 10-minute chart. This is where I showed you the setup to short it yesterday after, the long would have been covered right there at the open because we gapped up above the second final target, and then a nice pullback there, and now a little positive divergence here on the 10-minute chart. And if we could pop this trend line, maybe it'll go up. But crude's going to be the bigger, have a bigger impact on the energy stocks, especially big energy like Exxon and Chevron. And speaking of those two, this is Exxon. See breakdown, little back test, still below the trend line, and downside coming most likely. And Chevron, same thing, breakdown the other day, as I mentioned, back testing, and boom, down, big divergent high, negative divergence on the daily. So one of my favorites right now. Again, you can think of it simple. You can short energy, even though it is in a screaming uptrend. The trend line's broken, so there's a sell signal. Most might not see that. But, how much more is it going to go up? You're already hearing a bunch of buzz from Washington to start capping them and hit them for raking, percentage of their profits because they're making so much money, blah, blah, blah. Whether that happens or not doesn't matter. Point is, nothing goes straight up, and again, they're getting to the point where we're probably going to get a correction here. So you could be short energy and let's say long tech. I'd rather be short both right now, but that's just me. Let me show you the rest of the market here. So that's it for the sectors. What I wanted to show you is, let's do this. As we go through, I'm going to go through 2 time frames on the S&P 500. I'm going to rifle through the components very quickly because there's a lot and I want to get to them all. And we're just going to look at 2 time frames. So we'll do bigger picture stuff. I have the watch list. You can't see it on the right of the screen. I have all the components, all 500 components of the S&P 500. They're sorted by market cap. So keep that in mind as we go through. The higher the market cap weighting is, or the higher the market cap, the higher the weighting in the S&P 500, so the bigger impact it's going to have. But this is just going to kind of paint a picture, a more granular picture of the market since where we're at right now and what's happened so far. So Apple is the top component of the S&P 500, just like it is of the NASDAQ 100, and it's held up relatively strong. When you look at, this is a weekly chart. Here's a monthly chart. You can kind of see from the big picture here. Monthly chart. I'll turn off all the lines. And Apple, if I told you, or you looked at this chart and I said, we're going back into the 80s here, you'd say, wow, here's a stock solidly entrenched in an uptrend. And for the most part, it is, although it's starting to show some signs of cracking. So it's one of the leaders, again, that this one really hasn't joined the rank and file. It's kind of in between being market leader. It's down. Yeah, it's down off its highs. You have to put the percentage terms into relative values too, guys. I think people get tied up on point moves and things, even percentage moves. In other words, Apple's down 29% off, was down 29% off the highs. Right now, it's only down 23% off the highs. I say only. And you look at 23%, okay, that would be huge on something like a utility stock or some steady Eddie dividend paying blue chip. But on natural gas does 23% up or down within 2 days. I've seen it do that. I've seen it do that in a single day. So it's all relative to the security. Tech stocks are going to go up and down more. And so 23% to me is just a correction in Apple. It's not, Apple hasn't broken yet. When does it break? Well, that's the point of this video. This is still my current bear market target. I know it's heresy among Apple bulls to even call for something so crazy, 82 and change in the primary yellow uptrend line, but that's where I think it's going before all said and done. And this chart helps to show that. I've covered it many times. Again, remember, the biggest component of the S&P 500 we're talking about. These are all the bull market tops and bottoms, and you can see in primary uptrends, you've had these primary uptrend lines that define the bulls and bears. And I measured from the highs. That was actually a previous trend line break right here. 59% drop, 70, 74, 83, 42, 62, 45, 34, 39. So far, 29% back in on the June low, and that's all we're going to get. Very doubtful to see the bear market of this magnitude, the biggest increase in rates, the strongest inflationary environment in over 4 decades, and to think that Apple is only going to drop, that the bear market's over with a 23% correction, probably not. When will the next leg down come? Most likely after this trend line break, and you can see that that 20-week exponential moving average. And look, here's a support shelf. So keep it very simple right here. Under these recent lows, look for a solid weekly close about 134. So that's on a monthly chart. You can see it here on a weekly chart. A little better, not as well. Yeah, I like the monthly chart. It shows better there, but there's that 134. So basically the previous low. When it takes out that previous low, that's at 131, 132. It will have taken out. You can see it better here. This was resistance for that's over a year right there, and then finally you had a breakout. It was an ascending triangle pattern. You had a solid monthly close above it, a breakout, came in and back tested it and went to new highs, back tested. So when we break that line, it's lights out to me for Apple. And so that's what needs to happen, and then it will join the rank and file, meaning the other non-leaders. Right now it's still a leader, kind of to an extent buoying or holding up the entire stock market. And again, this is the S&P 500. Next up is Microsoft. Weekly chart of Microsoft, like as we had divergence, but this one I mentioned, this is what I'm starting to see. Some of these big leaders that had divergence, it's starting to get taken out. And when I look at the bigger picture of the monthly chart, here's what I see in Microsoft. I see the primary bull market uptrend line that comes off the 2000 and late 08, early 09 lows right there, and that's where I think this one's headed to before all said and done. That means, during this bear market. You have a secondary trend line right here, which was just recently taken out. It's nice and clean. That one comes off 2015. There's a lot of reactions on that trend line right there. And then when you zoom in, you see it was taken out along with that key 20-month moving average. Look at that. It's the blue dash line, does a bang-up job in the stock market, the S&P 500, the NASDAQ 100, of defining bull and bear trends. You want to buy pullbacks to it in a bull market. And then once it goes, which it did, you're below it, you're in a bear market. So this thing just triggered a sell signal. We got early sell signals back here on that initial trend line break with the divergent high. Then we've now had bull market trend line and trend indicator with the 20-month moving average taken out that just put us fairly relatively recently into a new bear market, and no support below. So that one, I think it's going lower, and that's what I'm doing here. I'm showing you the top components. Alphabet, right on my BOD line. This is my primary trend line right here. Come off the lows, and we already took it out. We have more reactions there. That's the one I prefer. It starts at that when Alphabet came public back in 04. You had a reaction there, big correction. That was the bear market, and ended in, for tech, it ended in November of 08. Everything else was March of 09. You visited again when COVID hit, and you visited again recently, and then you just took it out. And then we have a sell signal. We're below it. This one, the orange one, is what I call BOD, or benefit of the doubt, because if you want to take those COVID spike lows, remember, we recovered. They were monthly candles, and you got back up. So this trend line right here, my primary trend line, was never violated in COVID, not on a monthly basis. Remember, All that matters on the time frame you're trading, and this one's a monthly, is how it closes. So that red candle, you went down in the month of February, but you closed back above it. And then also in March, when the market bottomed out below it, to close well above it. So that was not even a whipsaw. And you can see that beautiful 20-month moving average also was defended on a monthly basis. So this is why it's different, guys. This is why this is not a correction. This is, to me, early stage bear market action, and as such, and until things like this start to change, where we get a solid monthly close back above the 20 months and these trend lines, I'm looking at, I'll play the bear market rallies, you know me, but then I'm looking to where to layer back in for the next big leg down. And the next one, this market's been orderly so far. We haven't spiked to levels on the VIX and some other indicators that say that's it for a while. Get long and stay long for a while. That hasn't happened yet, so I'm still looking for that leg down. Impulsive next leg down, I should say. All right, we're going to go a little faster here. I'll stick on the monthly for now, or else it's going to take forever. Some of these I might toggle over to the weekly. There's Amazon. There's my primary trend line. It is a beautiful trend line in my opinion. I look at charts. To me, it's like some people like art. That's their thing. They look at a painting and say, "Oh, this is beautiful." To me, charts. Some charts are beautiful. This one was 1997 when Amazon came public. You have major bear markets that have taken you back and corrections of that trend line. Many of them since, including that was the fourth quarter drop in 2018, or was that COVID right there? What is that one? That's COVID. COVID even took you back to it. And then what happened recently? We took it out. The yellow trend. This white trend line here is just a BOD, or benefit of the doubt, because there's a few spikes below that we recovered it, but that was it. So when Amazon took out during the month of ending in April 29th, the month of April candle, we closed a solid red close below both the beautiful 20-month. Look at that thing, just defining bull markets in one of the most strongest, longest bull markets for years. Since if you got in, it told you to get back into Amazon in March of 2009, and then it told you to stay long that stock until right here. It said get out. This is a solid candlestick close, and if you thought it was a whipsaw, you had confirmation the next month and the following month and the month after that. And then when you tried to make a run at it in the month of August, you got rejected off it. So again, this is, to me, everything you've seen up until now were just corrections in a much larger bull market, which is now over, and by a lot of these metrics, just getting going. So anyway, but Amazon, is down quite a bit off the highs. Alphabet, right now, it's taken out the primary trend line I have, but it's right on my BOD, or benefit of the doubt, right there, at least on this share class. So a little more downside, but it's below that 20-month moving average. Tesla's interesting. Tesla's been holding up relatively well. Everybody loves their Teslas, right? But look at this. That is a technical cliff, 205, in my opinion. It was resistance here. We popped it, and I'm going to count the number of candles since we back tested it after this breakout back here in 2020. I'm going to count them for you. 1, 2, close enough, so we'll call it 3, 4, 5, 6, 7, 8, close enough to call it 9. Last month 10. Right now we're on it. We're a little below it. So if Tesla closes a month, if we can get a solid close below it, lights out for Tesla. It's also below that key 20-month moving average. You can see it on the weekly chart right there. It's at same level. I have the line at 183.47. It's a beautiful little area of consolidation. Bullish if it can hold above it, and it's as I like to say, support is support until unless broken. If it takes it out, it's going to run at this trend line here, and if it takes out that trend line, then it's going lower. Again, Tesla's one of the top components to the S&P 500. Here's one. This is one that will join the rank and file. This is one of your stronger ones. Again, healthcare has been strong. Hospital systems and many healthcare plans, all that were just had cash shoved up their keister from the federal government when COVID hit. It was like winning the lottery. That guy in someone in California just won $2 billion on a big lottery. Powerball. Well, a lot of these hospital systems, if you read about it, they won the lottery when COVID hit. They got so much money. They were getting money for diagnosis, and that's why you also had overdiagnosis, from what I hear. But either way, it's neither here nor there. They were flush. So COVID to them was a boom. and it was reflected in the charts. But when I look at the chart, okay, so you might say, well, Randy, why? There's no sell signals on it right now, but it's going a lot lower. This is a big divergent high. The same negative divergences that led me to predict that Amazon and Apple and Meta and all that are going to be where they are today, back in 2000, late last year in 2021. They all had these same negative divergences on the weekly charts. They all had comparable trend lines, and they all broke and they all played out. And I see no reason why this won't play out. So a short on UNH, again, the point of this video, I'd have to, if you are interested in any of these, let me know, drop me a note below, and I'll have to then tell you when is it objective to short. Obviously a break of this trend line, but once this goes on a monthly basis, it's probably going to be a pretty powerful move down. You might jump the gun with a 60-minute chart or a daily chart. And again, there's just too many in this video. I wanted to cover some of the top to kind of give you a more rounded picture of the stock market and why, what's been strong, and maybe shifting our focus to start shorting some of those, or in the next leg down. Like I said, I think the S&P 500 is probably going to keep in line more so this time on the next leg down, and the Dow more so than before, staying in line with the NASDAQ 100. I made it pretty clear since the market topped that small caps initially, and then big tech, that was my preferred shorting proxies, and they were. But I think we're going to see a lot of these S&P type stocks, some of these companies that either aren't in the NASDAQ 100 or don't have much of a weighting. So there it is. UNH is just ripe for a breakdown. Oh, by the way, it already broke down. This is the primary uptrend line off the '08 lows. We broke down here, and we've just been back testing from below. So then I have this minor trend line that needs to go, and then once that goes, the stock will come back at minimum target on this time frame, which is a long-term time frame, is back there, 289.50. That's a 46% drop, 47%. Okay, so a lot of meat on that bone. And you go to the weekly chart, and there you go. You got a nice, beautiful little uptrend line right here. And so here, I'll do it right now. And you have negative divergence. See, that one's ready to pop. So I set an alert here, and when that goes off, that one will go in a basket. That might short this one here. You can see the 200-day moving averages. Look how this thing, it loves these 200s, and they hug the simple and exponential. I keep them both up on my chart. This is a weekly chart, so when you're on a weekly chart, a 40-week exponential or simple moving average is the same as a 200-day, and you can see this stock just loves that. Some stocks perform better to certain moving averages than others. This one, you can see they step in and bought it. When you break, then you're in bearish mode. When you're below them, you were when COVID hit, but then you recovered, and every single time it pulled back, the buyers stepped in and bought this stock. What does that tell you? Sell this stock when those 200 days are taken out, especially on a weekly closing basis, and you have a beautiful trend line that comes in with them. Nothing to me is better when I have a long trade setup or a short trade setup that I have not just one support level or resistance level which should trigger an entry, but multiple. And in this case, you have those moving averages and the trend line right there. So that's what I call high probability entry. If you get that sell signal, that means that trade has a very good chance of playing out. All right, enough on that one. Let's move forward a little faster here. There's the closing bell. Exxon Mobil, I already covered that one for you, but there it is on a weekly chart right there. And nope, that's a monthly chart, my bad. This is your weekly chart right here. And big divergence on the weekly forming. That's why these energy stocks look to me ripe for a nice pullback. And again, to play a game of catch up to the rest of the stocks that are in bear market mode. This one, it just, these energy stocks haven't gotten the memo. We're in a bear market, and eventually bear markets come and they find all the leaders. You're not going to see, I'm going over again the top components of the S&P 500, and a true bear market takes them all down. Some just resist longer than others, and then those are the ones you want to start looking for at this point into the bear market. We're already 11 months or so into the bear market. At this point, you want to start finding those that haven't yet been taken out to the woodshed, because they've got plenty downside to left to go. Probably more downside at this point than the big fangs that already are down quite a bit. J&J, Johnson & Johnson. Here's a beautiful trend line here on this weekly chart right here off the 2009 lows. That is your bull market trend line. This trend line has only had one single violation. It has a lot of clean reactions since that throughout this entire bull market. The only time it was violated and was telegraphed in advance. You had negative divergence when COVID hit, and it spent 1 week below, and the following week, well, 2 weeks below, and then you snap right back up. Remember, there's a lot of charts that I have these primary bull market trend lines, and that's why I said COVID to me was only a correction, but more accurately, it's what I call, it's another term, I make up a lot of terms, Ursa interruptus. It's my rough Latin for bear market interrupted, because the Fed would not allow a bear market that was priced in the charts and should have happened at the time anyways, COVID or no COVID, because it was priced in just like this one here, and you had the big 25% drop, bear market in J&J, that took you back to the primary trend line. So these were just cyclical corrections or cyclical bear markets, if you want to call them that, within this larger secular bear. When this thing goes, it's lights out for J&J. That's a major sell signal. Being that we're in such close proximity, I think it will go. Usually in a bull market, you get way away from the your primary uptrend line. You get the divergent highs, and those are just corrections that bring you back to your primary trend line, like these and these. This time around, we're a lot closer in close proximity. And to say that this bull market, again off the '09 lows, is getting long in the tooth would be a gross understatement. This is a bull market or a bubble of enormous magnitude, much bigger than a lot of the fundamental guys can wrap their head around, because they're just looking at earnings and other metrics that they don't realize that the intricacies of the of the financial markets and how things are going to change going forward. So that's one to look for there, and there's your sell signal when it breaks. And here's a monthly chart of J&J, and you can see the stock has these bull and bear markets and trend lines, and they this is that same one I just showed you. So we're getting very close. Look at that divergence on the monthly. Big divergence right there. Visa already broke trend. Visa right here, 2008, going public right there. There's your primary bull market uptrend line. It's nice and clean, like so many of these. Boom, boom, boom. We broke it here. It broke in 2021 last year, and just like Tesla, it's sitting on a shelf of support at about 185, and once that support goes on a monthly closing basis, it's lights out for Visa. Again, it's already below trend. It's already rolled over and now trading below the 20-month right there, and it's pushing up against this downtrend line. So it's kind of has this, if you look at it this way, you have a descending triangle pattern. Bullish if it can pop that, I will give it that. And if it does, who knows? Maybe it goes up for a back test of the trend line. Maybe it goes up for another run at the previous highs. But if it breaks below, there's your sell signal. And again, a long-term sell signal. If you're trading the monthly charts, it takes a while to get that confirmation. And when you get it, it gives you a trend change that's going to last for a time period measured in months or years, not days or weeks. My 60-minute charts, those are days or weeks, those trades. The monthly charts and the weekly charts, those trades are measured in months or years. Walmart's already dead. It just doesn't know it. Walmart broke this bull market uptrend line from the 2015 lows, had a beautiful bearish rising wedge pattern on the weekly, confirmed with negative divergences, had a solid sell signal with that big red candle through, and it's simply back testing from below. This is where Walmart is going before all said and done, in my opinion. I know that a lot like this stock in a recession because they sell cheap things, and but make no mistake about it. Just go back and take a look at the last bear market. You certainly had a drop back then. You could see it was dead money into the lows right here, and this was really peaked back here in '99, and it was going down all the way until the 2008 bottom right there, and kind of slogged around. So this is a pretty powerful sell signal, and again, that's where I think the stock's going over time. JP Morgan, banks have been strong as of late, but make no mistake about it, this one put in a major divergent high here on this monthly chart, just like it did back here in 2000, and you had a big wedge, And the stock fell back then, fell 78%. Then you had another big drop back here in the financial crisis, and the government bailed out J.P. Morgan and all the other banks, bailed out by the government. And you had, at this point in time, there's your primary trend line right there. I have a secondary trend line here, or another trend line, and that was the bull market, the primary uptrend line. It was taken out here, and that was the fourth quarter of, well, no, was that our COVID drop? Yeah, that was COVID. Yep. And back above it, but now below it. And this is the BOD, or benefit of the doubt, secondary trend line that needs to go. And that divergent high that we just put in says that it most likely will. Again, the last time we have a comparable divergent high was back here in leading up to the top in 2000, and I showed you what happened there. CVX, that's Chevron, that's a monthly. I've got some Fib fans on that. Here's your weekly. This is what you want to look at here. You have big divergence forming, just like on ExxonMobil. Nice, very well-defined uptrend line off the COVID lows. Look at that. 1, 2, 3, 4, 5 distinct clean reactions on that trend line. Divergent high. So another pullback, maybe another reaction on it. On the next tag, maybe not. Either way, this one's coming back down here to 135. I'd feel strong on that. It's at 185 now, so you're looking at about a 28% drop in Chevron, and wouldn't surprise me to see it go down through here and back test this trend line that's way down here. That would be a much larger drop. NVIDIA, I already covered this one. I posted this one back here. As a short, giving you 4 targets. 1, 2, 3, 4. We hit my second target recently and bounced. We hit my first target, bounced there, and we're sooner or later this one will start the next leg down, head down to my third target, and then ultimately my fourth target down there. So a lot more downside to go on NVIDIA. You look at it on a monthly chart, you can see the trend line I have here. This is our primary uptrend line. What was taken out, we had a minor trend line there, and big divergent high that says NVIDIA is going to be in for a lot of pain. And it's the nature of these. Yeah, I know that's, to some, those are crazy targets, but I've measured these out for you. People just don't get it. You just have to look back at history and see the nature. Again, everything's relative to a specific stock or a specific industry or commodity. The moves are relative, and the semis are known, and NVIDIA regularly has, when it has a bear market, it's not a 20% bear market or 30, it's a 56%, 86%, 90. Those are the, when we put in on this weekly time frame, when we put in these divergent highs, 1, 2, 3, 4, since the stock came public back in 1998, back there, it looks like late 98, early 99, you've had 4 major divergent highs on the weekly chart, and including the one that just happened. And the previous 3 were, like I said, 90, 86, and 56%. This one so far, you've hit my second target. You could have booked profits there if you want. It was a 67% drop, certainly within the realm of those previous ones, but I'm suspecting this one has more to go. We can keep going. We'll go to Lilly. Okay, here's another one that hasn't joined the rank and file yet. This is another leader. Again, that's healthcare. Eli Lilly, right? Beautiful bearish rising wedge here on the weekly chart, confirmed with negative divergence. Break of that wedge is going to take us down here to both the primary uptrend line and the intersecting 223 support level. There's your target. You just want it, set it, round it off, 223. And so no sell signal yet, but if you're if you've got the patience, to me the breakdown looks inevitable based on where we are in the wedge. We're getting close to that point where the wedge will typically break down. You short it here if you want it, and that's almost a 40% drop. So if you give yourself let's say a 10 or even 12% stop loss, that would be an attractive risk-reward ratio. You could have a stop up there around 406, 410 something, and target that 223 level. Again, this one, health sector will get their calling card soon, and you'll see a lot of these. And if you want to wait, be patient, wait to see these break down. Maybe you don't want to jump the gun because we're in an uptrend now, so you set an alert, And if you see Lilly break down, look at Pfizer, look at Merck, and look at the others in the sector, and you'll probably see them all breaking down in close proximity, and then you know that sector is rolled over and will join the rank and file. PG, Procter & Gamble, there's your uptrend line right there off the 2018 lows. Boom, boom, there's your reactions. Breakdown and back test. So this one already broke down. This one's already buckled. There was a big divergent high. It's been building divergence for years. Divergence has been playing out. Hit that trend line. We had one last bounce, one last hurrah, and then took it out. And now you hit this 121.81 target / support. Bounced as expected. You're back testing from below, and so you can short it here objectively, and or add the next break the next time it well, it hasn't broken it yet. When it breaks 121.81, we'll call it 121, and that'll take you all the way down to 94 would be your next target. So that tells me before all this is said and done, this stock, whether it goes up more first or not, I can't tell you for sure. Could back test for a while, could run at those 200-day moving averages above there, but you got about another 31% downside from where we're at today in Procter & Gamble. MasterCard, here's another one that hasn't given up the ghost yet, relatively speaking. Sure, it's down off the highs, but this one's been holding up. That's what I'm targeting here. These strong, quote-unquote, stronger stocks in the S&P 500. There's a beautiful support level, about 285, 286. And when that goes, and you can see these 200-day / 40-week moving averages rolling over. That's another way to use these things as an indicator. Look at the slope of your key moving averages. A slope is defined, if you remember, a slope of 0 is a flat line. Anything angled down is a negative slope. Anything pointing up is a positive slope. So you had a positive slope all along. Flattened out here, but it never went down. You had a little correction. These are the 40-week / 200-day moving averages. They started to flatten out there, but continue to move up. And see, now they finally turned down. They've rolled over. That is a way to recognize a trend change when you see these key long-term moving averages roll over, because they only point down and go down in bear markets. The last time they were going down, you got it, 2008. Then they flipped back up, turned up in 09, and haven't really turned down. They did turn down a little that period, and there was also a big correction for about a year in the stock, and it caught that. So these are some of the things I look at, and this one, it's also testing those moving averages from below, which is another sign that it's probably headed lower. And again, you can short it here on the back test of the 200 / 40-week moving averages, or you can wait for a break of 285 and tuck it away. BAC, Bank of America, again, a lot of these banks just need to take out these next uptrend lines. They put in these big divergent highs, and Bank of America is pretty much, didn't do that very well, but you can see pretty much back to where it was when it peaked all the way back in 2006, right before the financial crisis. It got almost back to that level, but unfortunately, I don't think it's going to make it back all the way back up there. It's going to probably take out this trend line and head down here to my bear market target of 815. Let's turn that on. There it is. But you need to take out, look, you're also at price support too. Very good price support here at 31. So 31 in that trend line, once they're taken out, there's your next leg down right there. HD, Home Depot, this is a monthly chart. This is our primary secular bull market uptrend line. It is the uptrend line. Home Depot came public back in the early 80s right there. So it had a bottom in about 1985, and it's just been one of the best growth stories out there. And you can see this is our primary bull market uptrend line off those lows. You visited a couple times in the last bear market, several times. You can't see it in the video. I have 4 different candles perfectly touching the bottom of those candles, touching that trend line there. You came back, you had a big correction in 2011, did it there. You kissed it to the button during COVID. Look, these are all, you can see these now. I zoomed in, there they are. Boom, 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 boom. And that's it. So what's going to get us down to the trend line is a break of 264. Like so many, it has this little shelf of support really since the bear market, since the market started stalling out in 2020, 2021. They broke out. A lot of stocks broke out to new highs, and they've been back testing that. So That's what Home Depot looks like on this weekly chart. Almost looks like maybe a little head and shoulders. Not much of a left shoulder, but there's your head. Not much of a right shoulder, but either way, I'll call it a neckline if you want on a head and shoulders pattern, or just call it price support. That level goes. You're going to be in very close proximity to the primary bull market uptrend line, and if that goes, especially on a monthly basis, it's lights out for Home Depot. Now we're talking much bigger, longer bear market. So these are the things to look at, but it's also a near-term target. If we break the 264 level soon, hit that trend line, you could step in and buy. That's a 25% drop from where we're at right now. And that's it. So I'm going to go. That was Pfizer. This is AB. I don't have these all marked up, and I do on the weekly charts. I could show you that. There's ABBV, another healthcare stock breakdown and back test. I skipped over Pfizer. Let me go back to that. Pfizer broke down on the weekly chart, the uptrend line. There's your primary downtrend line off the highs. Probably get rejected there off the trend line. If it doesn't, maybe a rejection off the back test of the primary uptrend line. More downside to come in the healthcare sector, in my opinion. I already covered ABBV. Coca-Cola, calling cards coming soon. Big divergent high right here. And there's your primary uptrend line off the COVID lows. That's the trend line, the best I could fit. I'm not crazy about it. Here's a more significant trend line on the monthly, but not crazy about this one, but I do think it's going down. Merck, there's that trend line on Merck right there. Let me put my drawing tool back up. Off the 2009 lows, so that was the end of the last bear market. A beautiful trend line. Look how many reactions on that. Not a lot since the initial, but then it picks up here. All these pullbacks. So it's got a ways to go before it's broken. I'll set an alert now, just in case I forget about it. That could take months, or it could take a matter of weeks. We'll see. What I can tell you with certainty is we have negative divergence. It's not confirmed yet. We need to turn back down and confirm it, but there's a big divergence right there. Pepsi, beautiful uptrend line. Again, we're on monthly time frame here, so you can get there quick. Remember, in a bear market, there's COVID right here. It only took, you could see, those are two monthly candles that dropped that much. There's one single monthly candle right there. So even though right now we're comfortably above there, that is a key uptrend line. And at the very minimum, you've got divergence here. These are the market leaders. I think they're the market snipers, if you will. I'll call them the bears or short sellers or whatever you want, or longs that are starting to take profits on their, things that are up. Hedge funds, pension funds, things of the like. They may start selling soon, and that would be your downside target at minimum, is a pullback to that monthly uptrend line, so about 17% drop in Pepsi. I look at it on the weekly. I really like Pepsi as a short setup here. You've got a nice clean uptrend line right there. One little violation in COVID. Other than that, lots of reactions. Negative divergence on this weekly chart. I already showed you the divergence on the monthly. And there's your first target on the weekly. It's 48.18, give or take. Second target zone right there. And third and final target zone there, from about 100.50 down to 92 and change. All right. That's it. I mean, I can go through here. We already know what happened to Meta. There's no reason covering that. Costco coming down to this primary bull market uptrend line before all said and done. McDonald's, another one coming down there, and the monthly chart tells me it's going to break that. You got a big wedge here on the monthly. McDonald's has so much to fall before this bear market's over. Now, of course, it's one of the strongest ones. It's up near all-time highs, bull market highs. So this one I would certainly go after. This one they're going to get, and it's going to come down. It's going to take out this trend line ultimately, and you've got a lot of downside in McDonald's. So that's one of my favorites as well. Look at this on the weekly chart. Just keeps making these series of divergent highs, and it's not as if they don't work. Each one is a big correction, a very profitable, tradable correction, but it's just one series of divergences that continue to extend, and that shows better on that monthly chart. And so there's your primary, very clean uptrend line and price support. So if you want to set an alert, set it at 227.94, or set an alert at the trend line, and that one will be, that's a kind of like a trend short. Short it when that breaks. You can actively trade it like I tend to do, cover at the targets on the way down. That's how it'll probably fall. or you can just tuck it away if you're not an active trader and set your stops and periodically lower your stops if the trade starts to pan out. All right. Um, I should stop here because I can go all day long when you get me talking about charts, as you know. But there's Oracle. Oracle just actually put in a divergent low, so but it bounced already. But bigger picture is Oracle's. Look at this trend line. It's just sitting right on top of this trend line here. So these are the things, bigger picture, and it might take. It could be next year if they even do break. But when you start seeing these top components of the S&P 500 breaking these long-term, these multi-year and in some cases multi-decade trend lines. This one goes back to the 90s, late 90s. Then that tells you we're going to be at that point we'll be in, and I think more and more people acknowledge a Japan type, 1990s, 2000 lost decade, they call it in Japan. And as of now, again, this is super long-term stuff. But again, the takeaway is I showed you some of the stocks that haven't been taken out to the woodshed yet, and that will very likely present some attractive swing shorting opportunities here, especially for the next leg down in the bear market. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.